Hi, everybody. Welcome to the exclusive property market update for April 2019. My name is Luke Graham, and I'm the head of research for Touchstone Property Intelligence. Today, we're going to speak firstly about property as an asset. So we understand that, or you might understand that there are a few different types of assets that you're able to invest in. We're going to have a look at how property actually fits into that world. Then we're going to have a talk about the 5 pillars that drive our property research. After that, we'll do a market update focusing mainly on the major capital cities, and then we'll talk about the process of investing with Touchstone Property Intelligence. After that, we'll have a bit of an opportunity for questions, but those of you who are watching on YouTube, you'll miss out on that. But you're always welcome to reach out to our team for any questions that you might have anyway. So my email is luke@touchstoneintelligence.com.au if you're interested in getting in touch with me. Otherwise, colleagues such as Hoda and Pim, just substitute my name for theirs in the email line, and you'll be able to get in touch with any questions that you have. There are 2 main types of assets that you're able to invest in. The first is financial asset, which is probably the type that people think of most immediately when they think of investment. Some examples of that are shares, derivatives, bonds, and the currency market. Whereas real assets, or what I like to call more tangible assets, such as precious metals, collector items, machinery, and real estate, the types of assets that you're able to hold in your hand. Whereas, as an example with shares, you're not actually holding a share in your hand. It's usually a contract, and that contract is typically now on your computer rather than in your hands as a physical copy. And obviously, today we're going to be focusing on the asset type of real estate, which falls under the category of real assets. Now, under real estate, there's a few different types as well, and a few of the main ones I've listed here. So commercial real estate, a lot of you probably work in commercial real estate. Industrial real estate, a lot of your grandparents or parents may have worked in industrial real estate. Retail is where you go shopping. Special purpose, some examples of that is aged care facilities, which is a booming industry at the moment because of our aging population. Other examples include pubs, clubs, hotels, and things like that. And then obviously we have residential property, and today we'll be focusing on residential property. As a residential property investor, there are 2 main ways that you can approach your investment journey. One is active and the other is passive. Now, I've been thinking of a different word to use instead of passive because some people don't take to that word too kindly. But I'm a passive property investor. Most people I deal with are passive property investors, and we'll actually be focusing on passive property investment today. An example of active property investment on the extreme side is being a major property developer. And that's obviously not just a full-time job, but typically requires quite a few employees as well. On the less extreme side, you're looking at the people who buy and renovate for profit and those sorts of things. Active property investment is very speculative and much more hands-on. Our client base tend to be working professionals who are better off managing their time by sticking with what they're good at. You might be in professional services or some other type of line of work like that, and don't have the time or aren't willing to set aside the time to spend months upon months renovating a property or project managing a property development or something like that. The benefits of passive residential real estate investment include lower volatility. So it's usually a much longer term mindset, which is considered to be a little bit more of a conservative approach to property investment. Cash flow is much more stable. That's your money coming in and going out each month, week, fortnight, whatever it happens to be, however you'd like to measure it. Credit and leverage is much more straightforward as well, particularly since banks are much more familiar with lending to passive property investors because they're much more similar to owner-occupiers as well, the people who buy houses to live in them. It's far less time-consuming, as I mentioned, and it also allows you to access portfolio diversity a lot better. And the benefit of portfolio diversity is that you have a lot less risk in your portfolio. So as an example, if you're investing all of your wealth into a property development and that property development goes belly up, and then that's all of your wealth gone. Whereas if you distribute your wealth across various assets and one of those assets performs poorly, that's only one small part of your portfolio that's performed poorly, and hopefully other parts have performed better over that same period of time. Now, in order to make sure that your assets are performing in a good way and your risk is mitigated at the same time, we work with what we call the 5 pillars of property research, and they are demographics, economics, regulation, performance, and product. We'll start with demographics because not only is that the first listed in our pillars, but it's also the one that I find most entertaining. So the current population of Australia is estimated by the Australian Bureau of Statistics to be 25,335,120, and that surpassed 25 million last year. The total Australian population between 1788 and 2018, you can see there with the black line, has skyrocketed. And there are two main areas over this period of time where this occurred, or where the gradient shifted significantly. The first was the gold rush in May of 1851, which is where we saw a major population boom of people moving down to Victoria. Now, this era is actually what ushered in the debate between Melbourne and Sydney as to who would become Australia's capital, which is why we're now stuck with Canberra, for those of you who aren't a fan of Canberra. Now, we still see the legacy of the gold rush in the mid-1850s as well, in the mid-1800s as well, because of the architecture of Melbourne. So if you drive around Melbourne and you see some of the really pretty marble and bluestone architecture, that is a legacy of Melbourne actually at one point being the world's wealthiest city. So the gold rush had a huge impact on Australia and Australia's future, as did our experience during the Second World War. So before the Second World War, our immigration policy was very protectionist, a bit of a shady part of Australian history. But after the World War II was over and we realised how exposed we were to foreign enemies with such a small population, we completely fundamentally recalibrated our attitude towards migrants, and as a result our population absolutely skyrocketed. And that was also assisted at the same time by the baby boomers, so the generation of the baby boomers who started or who began around about the end of the Second World War. So from, I think, 1946 onwards is the baby boomers. So more than half of Australia's population actually live in one of our 4 cities, which is a very interesting demographic statistic when compared against similar nations, culturally similar nations like the United States, United Kingdom, Canada, and New Zealand. Another element I wanted to touch on when it came to demographics and the analysis that we make is the fact that parts of our pillars of property investment actually come and converge with one another. And a good example of that is the performance of the Sydney property market and net interstate migration to Queensland. So although the chart there is probably quite overwhelming to look at, you can see on the side there, we've got from 1998 to 2003, the Sydney median house price increased by 83%, and we saw a 136% increase in Queensland migration over the same time. Now, between 03 and 08, the Sydney house price didn't really do much. It increased by 3% over that period of time, and as a result, we saw a decrease in the amount of migration growth in Queensland by net interstate figure by 52%. Okay, that still means they had a positive figure. It just wasn't as strong as it had been in the past. Now, what that shows us is that when Sydney becomes more and more unaffordable, people are more and more inclined to move to Queensland. And they're driven by not just affordability, but also lifestyle factors. And they fall into what's known as a reinforcing feedback loop. So when talent moves up to Queensland from Sydney, then at the same time, there's a stronger level of demand and more economic activity because of those people, which then encourages more to come and those sorts of things. And in the past, Queensland migration has actually been somewhat dependent on the resources sector, but as we're seeing through this wave of net interstate migration growth, Queensland is becoming an economic power in the service economy in its own right, which is a fantastic sign for Queensland and a great shift away from the more volatile resources sector. The data is still yet to come out on net interstate migration to Queensland in 2018, but because of the recent Sydney property price boom, we're seeing that already there's a huge level of growth in the migration figure from 2013. We're seeing some evidence of what I've just said actually in a lot of media reporting. So from 2017, we're seeing here why are some of the best workers fleeing Sydney. And we'll actually look a little bit later as well at the huge difference between Sydney and Brisbane when it comes to property prices, and therefore how that's able to impact people's lifestyle and the compromise that people living in places like Sydney are definitely willing to make based on the trade-offs that they can achieve by moving to somewhere like Brisbane. One of the drivers of economic performance when we're looking at property markets is infrastructure investment. And again, we're going back to the case study of Brisbane. So I've got a couple of examples here. On the left, in 2020, we're going to see the delivery of Brisbane Airport's new runway, which has a major impact on not just the amount of arrivals that are going to be coming into Brisbane each year, but also other infrastructure projects around the country that are going to be experiencing a higher level of demand and pressure, which is exceptionally beneficial to the Queensland economy. One of those beneficiaries will be the Queen's Wharf development, which is a casino geared towards the Asian market, which is expected to be delivered in 2022. And we also have an example of a government project, 2024, we're expecting the Cross River Rail to be complete, Cross River Rail project, which will deliver an additional 10.2 kilometres of railway and 6 kilometres of underground tunnels. Another thing that we look at when it comes to economics is how economic drivers and performance change over time. And there's perhaps no better example of that in recent history than manufacturing. So in 1959, 30% of Australia's GDP was entirely directly dependent on manufacturing. And in 2019, that has declined to being less than 6% of Australian gross domestic product. Now, this has a few consequences. Not only does that mean that a lower proportion of Australians are employed in manufacturing? Since it's been automated, there's an even lower number again. But also, excuse me, I've got a little bit of a cold. Also, that property that was highest and best use in manufacturing, so warehouses and other types of industrial real estate, is now being repurposed into residential property. And areas where that has definitely happened, if you're a Melburnian, you would have seen that in some parts of Collingwood, some areas around South Bank. In New South Wales, you would have seen it in places like Waterloo and Zetland. Those areas initially were quite heavily populated, which was the homeland of the South Sydney Rabbitohs rugby league team. And over time, when that residential area became industrial areas, the South Sydney Rabbitohs had to move their recruitment base further and further east, which started impinging on the Roosters' territory. And so now we're seeing a bit of the opposite of that, now that that industrial property is again shifting back to residential. My question to you would be whether a diverse economy is important. So we've seen that Australia in the past was dependent on manufacturing, and if we still were dependent to that same level, our economic performance arguably would be much lower than it is today, and it's been supported by the industries that have replaced manufacturing, such as the service economy. I wanted to look at a case study of an area that did not have a diverse economy and correlate that with property performance. This is Gladstone, as you can see on the chart, and the graph is sourced by APM Price Finder. You can see that on the blue line, which represents the median sale price, that it peaked in late 2011, early 2012, and subsequently plummeted through to 2015. But the green bar, what you can see there is the number of sales made each year, which also happened to peak in around 2010 and 2011. So what this shows us, which we're going to talk about a little bit later as well, is that typically during a property boom, what's driving the property boom is an increased level of sales. So when you hear that it's a great time to be investing in a market, and you will hear other commentators say things like this, that, you know, the old idiom that once you've heard it in the papers, it's too late. And a good example of that is what you're seeing here. So once you hear the butcher, the baker, and the candlestick maker telling you that a certain market is a good investment, typically the best investment opportunities have already gone, and you'll find yourself in that area of 2010, 2011, where you're not really benefiting from growth. You're the person fueling the growth. So whoever's selling the property to you, they're the ones benefiting from the growth. But the point I wanted to make about why that market shot up and shot down so substantially during that period of time was the LNG gas pipeline construction. And I highlight that word construction because the construction of that project was the period where the highest amount of employment was. After the LNG gas pipelines had been built, the amount of employment in the area plummeted because they were very heavily automated systems. So it was just the construction themselves that was the main economic driver or the employment driver in that area. Now, if you were reading certain real estate investment magazines and stuff at the time, which I happened to be, and I've got evidence of that while on holidays, I think I was in Spain at the time. I had to crop the image because I think I don't have a shirt on. You can see I'm sitting there on the beach. You can see advertised Gladstone LNG corporate rental properties for sale, 7% returns, all those sorts of things. So there was a huge amount of drive and demand right at the cusp of the downfall. And so again, what I want to emphasize here is not just the importance of having a diverse economy, i.e. something that's not just dependent on one driver, but also being aware that strong levels of or attractive, too good to be true type stories usually require a little bit more further analysis, which is why we look at the 5 pillars of property research rather than just 1 or 2 of them. Now, regulation is one of them, which is one of the more painful pillars. We know that the cash rate is still sitting at 1.5% set by the Reserve Bank. Other elements of regulation that influence the property market include planning law, which is typically driven by the local and state governments. Monetary policy, as we touched on, one of the major parts of that is the cash rate. The federal budget has a major influence on that, and something recently that's really brought the federal budget into the spotlight has been the Labor policy on negative gearing, which again we'll talk about in just a moment. State budgets also influence the property market. Examples of that include stamp duty policies and first homeowner grants and things like that. Non-government organizations, lobbyists influence the way that professionals are able to operate in the industry. And we saw that recently actually with the Royal Commission into Financial Services, which was, as some perceived, including myself, unfairly targeting mortgage brokers and not targeting enough of the major banks. And of course, very closely related to that are industry watchdogs. Since negative gearing is a very hot debate at the moment, I wanted to take an opportunity just to quickly touch on some myths around negative gearing. So a lot of people have been deterred from property investment recently because of the uncertainty of the Labor policy surrounding negative gearing. But a point that we make to people is to remember that if you're buying new property, then those changes will not be affecting you anyway. So this is kind of a bit of a smokescreen because the people who benefit most from negative gearing are the people who buy new property. The reason the government doesn't target new property, whether they're Labor or Liberal, is because investors, property investors are the ones that create new supply of property. And if you're deterred from buying new property, then we would have a major undersupply housing shortage crisis, I should say. So yeah, it has been worked up a lot more in the media than how it really is. But at the same time, it's good to be informed of it anyway. Now, if you do own property already, it doesn't matter. And if you buy a property before the policy and it is secondhand, that doesn't matter either. If it's secondhand established, however you want to phrase it. The only people it impacts are people who, after the policy, buy a property that isn't exempt, and that is a secondhand, an old property. But buying that old property anyway, you're probably not going to be able to claim depreciation. So a lot of your negative gearing doesn't apply anyway. So the only thing you're set back on there is mortgage interest, which is still considerable. So if you're confused about how it impacts you directly, personally, definitely have that conversation with the Touchstone Property Intelligence team. Again, this presentation is obviously quite general in nature. We're not talking about your personal circumstances. So it's important when listening to this presentation that you also get feedback on your personal circumstances rather than just a generic market update. Performance of the property market is obviously quite important for those of us looking to invest. And we can break up the measurement of the performance of the property market into 4 major stages of the property cycle. The upturn is when things are starting to look good. Boom is quite obvious. That's when prices are going crazy. The correction is an example of that is what we're seeing in Sydney at the moment, where prices after the boom go back to a kind of normal level. That doesn't mean they go back down to where they were in the past. It's a natural part of the property cycle that we expect. And then the stagnation, which is typically the longest part of the property cycle, which is where not really much happens. It might go up a little bit, it might go down a little bit, but in real terms, not much is really happening in the market. Another interesting element when we look at performance is the relationship between different markets. And you can see one of those right here with the median house price between Sydney and Brisbane, but we also can look at things like houses and townhouses, or townhouses and apartments, or houses and apartments, or whatever it happens to be. Now you can see that since the Sydney boom, over recent years, the gap between Sydney and Brisbane has grown substantially because the Brisbane median house price did not increase at anywhere near the same rate. Now, this drives what we were talking about earlier, such as people being driven by lifestyle factors moving up to Queensland, where property is much more affordable, and driven by other lifestyle factors such as climate and those sorts of things. But this is very helpful for us in determining what sort of areas are opportune. This on its own is not enough to say that Brisbane is a great investment just because it's much more cheaper than Sydney than it has been in the past. There are obviously many other drivers than just that, many of which we've gone through already today. But it is one major interesting factor that helps guide us in not just what markets have the potential to grow in the future versus others on a likelihood basis, but also which ones are less likely to experience larger corrections. So as an example, when we look at this graph, we can determine, particularly since weekly household incomes are quite similar between Sydney and Brisbane, that the market in most risk of going through a correction, which is exactly what we're seeing right now, is Sydney, not Brisbane. Another element of property performance that we must look at as well, since you're a property investor, is the rental market performance. And in the past slide, what I want to look at here is the residential vacancy rate, rental vacancy rate. And what that is the percentage of rental homes in a certain market that are vacant at any one time in a particular suburb or postcode. So we see the top postcode there has had periods of major oversupply, where you can see the yellow line, which is what I determine as equilibrium at 4%. And that market on the top graph has spent most of its time well over 4%, even hitting 12% a couple of times, and taking quite a long time to get back into a state of equilibrium again in the market. Whereas just below it, the graph below, you can see that it spent this market almost its whole time in significant undersupply, only once hitting equilibrium for a period of about a month before again going back into major undersupply. And so what I want to illustrate to you with these graphs is how different, we've spoken about the Sydney market, we've spoken about Brisbane market, Melbourne market, those sorts of things. But these markets don't just exist in a macro generic sense as Sydney, Melbourne, and Brisbane. There are very big differences from a suburb to suburb and postcode to postcode measurement or basis. Now, if we look at these two charts, we can see one is the postcode 3008, the other is 3066. And the interesting thing about these postcodes is that if we look at Melbourne CBD just here, which I've outlined in the orangey yellow gold color, you can see Docklands highlighted in red and in yellow, Collingwood. Now, there is just 3.5 kilometres across Melbourne CBD between these two markets, yet they're the two markets represented in those graphs. And so again, when it comes to investing in a market, it's important not just to think to yourself, well, I'm investing in Sydney or Melbourne or Brisbane or something like that. It requires a much more nuanced approach. You'll notice that throughout this presentation, we haven't even looked at a property or spoken much about property itself, rather just markets, but product is where we start getting into that. Some of the factors that we look at when we're assessing one property against another is things like standard of finish, design, quality, and efficiency, external amenity, property type, relevance to the demand. And relevance to the demand is a really important one. We talk about undercapitalization and overcapitalization. And it might sound a little bit elitist having this conversation. Excuse me. But it's an important distinction to get across for an effective property investment.